Hello and welcome to Business Standards Morning Show. I am Ruchika Chitravanshi and let us take a look at the headlines for today. The share of information technology sector in India's GDP has risen from 1.2% in 1998 to almost 10% in 2019, and it has made its presence felt globally too. Six Indian tech giants, led by TCS and Infosys, are now among the 25 most valuable IT brands worldwide, according to Brand Finance. TCS is now world number two, just behind Irish giant Accenture. Our next report tells us more about the Indian IT industry's journey so far and also about the road ahead for it.
On January 16th, Union Commerce and Industry Minister Piyush Goyal said that India's IT industry can play a big role in raising services exports to $1 trillion a year. In a virtual meeting with a clutch of top leaders from the IT industry, the Union Minister assured the government's full support to the sector. The assurance, which has come just days before the Union budget, is a confidence booster for the sector. And amid strong Q3 performances, the Indian IT sector got another shot in the arm this week. Six Indian IT companies found themselves in the top 25 list of most valuable global IT brands. Tata Consultancy Services, or TCS, has become the world's second most valuable brand in the IT services sector, according to Brand Finance's recent Global 500 IT Services Ranking report. On the top of the list is Accenture. TCS grew its brand value by $1.84 billion, or 12.5%, to $16.78 billion in just over the last 12 months. Infosys came in at third rank with a brand valuation of $12.77 billion, and apart from the two giants, four more Indian companies feature in the top 25 IT services brands. The average growth of Indian brands that have appeared in the Brand Finance IT Services ranking since 2020 is an impressive 51%. The US brands have on average contracted by 7%. Both TCS and Infosys reported a healthy quarter-on-quarter rise in their consolidated net profit in the quarter ending December 2021, while TCS saw its net profit increase 1.51% to Rs 9,769 crores. Infosys saw its net profit increase by 12% to Rs 5,809 crores. And the top 5 Indian IT companies, namely TCS, Infosys, Wipro, HCL Technologies, and Tech Mahindra, are expected to report around $70 billion as combined revenue in the ongoing fiscal year. The pandemic has dealt a big blow to India's unorganized sector, but it helped several organized sectors register a good growth. Over the last 2 years, Indian IT companies reaped rich dividends as the world underwent digital transformation at a frantic pace. India's $194 billion IT industry has been a big beneficiary of the pandemic. It spurred global companies to bolster investments in services ranging from cloud computing, digital payment infrastructure to cybersecurity. In fact, industry body NASSCOM has recently pointed out that before the pandemic, Indian IT companies were reporting annual growth rates of around 6 to 7%, which have now increased to around 15 to 20%. However, the industry's growth has brought with it an increased scale of attrition. Indian IT majors and newer tech startups flush with venture capital money are competing for the same talent pool, and as evidenced by payment startup BharatPe luring techies with the promise of BMW bikes and paid holidays to Dubai, the entry of these VC-backed startups is driving up the industry's compensation metrics, leading to higher attrition rates, which for most companies including TCS hovers around 15 to 16% today. We spoke to D.D. Mishra, Senior Director Analyst at Gartner, to find out how Indian IT services firms can sustain their momentum.
This market is crowded, and over a period we have seen that newer players are coming and the perception of value is changing. Now in this market, clients are preferring players who are more valuable than visible, and that is where I think Indian IT industry needs to drive their own constructive destruction in order to make themselves more competitive over a period of time, make themselves more valuable for their customers, and ensure that they remain relevant for the customers with the changing needs. Market is driving a lot of changes in the providers. A lot of providers are going through merger and acquisition. Some are spinning off new organizations and new companies. And there's a lot of volatility which is there in the market at this point in time. I would suggest that Indian IT services companies who are actually focusing more on the larger deals should start reimagining the whole situation again, that whether they are creating a legacy heavy kind of business where it will be very difficult for them to drive the transformation. And this is where I would say that the IT companies need to think again and try to drive better performance and better efficiency by picking up deals which can be profitable over a period of time and which can help them in driving more digital growth, digital revenue growth, rather than creating a lot of legacy workload with them, which is not going to be very profitable.
Even as Indian IT services players keep pace with their global peers, they need to be ready to adapt to a volatile market where change is the only constant. Another question that remains open is what will happen to the industry's momentum if and when the rapid pace of digital adoption driven by COVID-19 settles down.
From the Indian IT giants, let us now shift our focus to the looming war clouds over Eastern Europe. The mounting tension between Russia and the Western world over the Kremlin's military buildup on the Ukrainian border is also providing the bullying fodder to the oil market. For the first time in 7 years, oil touched $90 a barrel, and a disruption in supply may push it beyond the $100 mark. So, what such a rise will mean for the Indian economy, and will it upset the government's budget math? Our next report finds out some answers.
India is the world's third largest oil importer. It imports 86% of its crude oil requirements to make the petrol and diesel that is sold by domestic companies like Indian Oil and Hindustan Petroleum. Iraq is the top oil supplier. Saudi Arabia, UAE, Nigeria and the US are other key sellers. Therefore, any geopolitical tension affecting the supply of crude oil does not bode well for the Indian consumers as well as the government finances. Crude oil prices have been on the boil for some time now, gaining around 60% over the past year because of tight supplies. The OPEC Plus, which includes the cartel's allies led by Russia, has been failing to meet its monthly production target since last August. Brent crude, the global benchmark, touched $90 a barrel for the first time in 7 years as rising political tensions between Ukraine and Russia added to concerns that supply could get even tighter. A potential invasion of the oil and gas transit hub of Ukraine by Russia, which is one of the world's largest oil exporters, could disrupt supplies of the key commodities. Analysts expect oil prices to hit $125 a barrel if the situation escalates into a war. Amish Shah of Bofa Securities told Business Standard how oil prices may trend over the medium term.
Over and above the geopolitical concerns, COVID is now looking like getting into the endemic phase, which means economies globally will open up, and therefore the demand for crude is likely to increase as well. As you and me now start to travel as well. So on the back of that, in the near term, up until June, we think that crude will go up further and hit $120 a barrel mark. But at the same time, we do think that supply will eventually catch up. And once that happens, as an average for this calendar year, we think crude will settle down at $85, on an average. So crude is already at around 85 right now, which means that in the latter part of the year, in order to come back to 85 of an average, crude will have to be lower than 85. So it's going to be a little bit volatile, swinging up on the upside and then coming on the downside. I would call it out as a risk factor, which could lead to small correction in the market as we go along from now to June.
The dependence on overseas supplies in a high-priced oil market leaves India vulnerable to higher inflation and a weaker rupee. India's crude oil import bill is expected to touch a record $111 billion this fiscal, which will worsen the current account deficit. If oil prices stay at higher levels rate hikes from the RBI can be expected quicker, say experts. As oil prices fell dramatically from mid-2014, the government took advantage by steadily increasing excise duties on fuel. As a result, central excise collection on petrol and diesel increased very steeply, from 1.37 trillion rupees in FY15 to 2.42 trillion rupees in FY17 to 3.72 trillion rupees in FY21. This improved its finances and brought down the fiscal deficit gradually. However, due to increased government spending to arrest the pandemic-induced slowdown, the deficit worsened to 9.3% in FY21. This time, economists expect the government to meet its fiscal deficit target of 6.8% of GDP. While the centre cut excise on petrol and diesel last November, if it is once again forced to reduce the levy to curb inflation, it will hit excise collections. A fall in revenue will harm the fiscal deficit numbers and also the government's fiscal consolidation plan of bringing the deficit down to 4.5% by 2025-26. Madan Sabnawis spoke on the challenges that the government will face in budget making if high crude prices are expected to persist.
In case we're looking at something like $100, $120 per barrel for the next financial year, I think what the government would be keen to look at is as to what exactly should happen at the retail end. Because we have seen that the prices of petrol and diesel have not really changed, even though the price of crude oil has touched $90 per barrel, ostensibly because we have the state elections coming up. But I'm quite sure that once the elections are over, probably in the month of March or so, there will be revisions which take place in price. Now, this is where the puzzle is really there for the government, because when you're drawing up a budget, I think the assumption which we make of crude oil price is very critical, because it's based on this particular number that a number of your tax assumptions are made, especially on the indirect taxes. And given the fact that today inflation is already in the region of around 5.5%, I think the government cannot just ignore saying that let the prices go where they are. I don't mind petrol now becoming 120 rupees a litre, because nobody really objected when the price was 110. So 120 should also be bearable. Because as the prices go up, freight costs also go up, and that will feed into overall inflation. And probably it may talk to the states and nudge them to do something about that to make sure that the prices don't escalate to that extent that inflation goes out of hand. Now, in terms of expenditure, it will, of course, mean a certain minimum additional outlay which will have to be paid on products which are being subsidized, like kerosene and LPG. But that may not be a major dent as such, or it may not be a major concern, but you definitely have to make a higher provision. Maybe another 5,000 to 8,000 crore rupees more will have to be made provision in terms of the subsidies. And this is a particular year in which the government would be looking also at increasing capital expenditure, rationalizing subsidies. I think that's what we spoke of before the price of crude oil reached the levels where they are today. And therefore, I think this will be another tough call for the government to take.
The government, therefore, is in a precarious situation and must prepare the budget based on a reasonable assumption of crude oil prices, as inflation number will become the base on which fiscal deficit projections are made.
While oil prices soared, that of gold fell over 1% on MCX yesterday, in line with equities. But the weakness in the prices of the yellow metal is prompting Indians to buy more gold. The demand for gold jewellery had hit a 6-year high in 2021. So, is the trend here to stay as investors flock to safe haven assets in the backdrop of risks to inflation amid rising oil prices and faster than expected rise in interest rates in the US? Business Standard's Puneet Wadhwa caught up with Soma Sundaram PR, Regional CEO India at the World Gold Council, to understand how the gold demand is likely to pan out in 2022.
Can you shed some light on how the gold demand globally and in India has played out in the December quarter and in 2021?
Demand is up for the global by 10%, largely driven by a revival of the consumer side of the demand. By consumer side, what we mean is jewelry and bars and coins. Most of the markets have shown a return to the pre-pandemic levels. It could be due to the pent-up demand being released and relaxations of lockdowns, all of which have contributed to a very, very big surge in both jewelry and bars and coins. There are two different stories, of course. Jewelry is more to do with social functions coming back, lockdowns being relaxed, and people coming out in large numbers, having a lot more savings because there were no other forms of spending, and much of that could have flown into gold and a softer price as well. So all these factors have contributed to having one of the best quarters for the consumer demand. Specific to India, if you were to say, this has been one of the best quarters in our data series. Quarter 4, I'm talking about. So this is, if you look at India, it's a 343 tons, demand for the fourth quarter, which is one of the best. So it's almost 85% growth over what we saw last year. Again, last year, while the first 3 quarters were very, very different, and particularly quarter 2 and quarter 3, quarter 4 was near normal because there were a lot of relaxations, etc. So against that comparison, this has shown a very, very significant growth. And as I said, largely driven by softer prices, social functions coming back, people having more money to save, so they probably invested in gold, and a certain expectations of what probably the gold price will do in the next few years.
Okay, given the US Fed meet outcome and the possibility of a sooner than expected hike in rates now, how do you see the demand playing out for the rest of 2022?
Well, as I said, part of this is also the pent-up demand. People couldn't buy quite a bit, and they came out. Lockdowns were relaxed, and vaccination program is considered successful. So there was a general positive sentiment as well. Now, will this repeat in 2022? We believe, yes, there will be a new normal, but whether it will be the kind that we have seen, 340 tons. 340 tons, Puni, just to give you a benchmark, it was 2013 second quarter, which was one of the best. That is when we had 80-20, because the demand rose so high that the finance industry came out and said, we can't afford this and we need to curb this. This has even exceeded that demand. And the price at that time was 40% lower. So you can imagine what kind of investments have flown into gold. Now, will this get repeated? Yeah, demand will continue to be high in our view. Demand will continue to be supported by people coming out, higher savings, outlook on price, outlook on gold, social functions.
Can you quantify the demand expectation and the average price points in 2022?
As you know, we don't forecast the prices at all. All we are saying is, yes, there is an expectation of interest rate rise, but it is not clearly only interest rates which we should be looking at. We should be looking at real interest rates. We should be looking at inflation. And there are many other factors that drive people to buy gold. Yes, as I said, we will see a new normal. We have in the past seen 850 tons of demand on an average. Post demonetization, we saw that coming down dramatically, average to 700 tons. Now, we cannot parse the reasons for this. It could be due to demonetization, it could be due to more compliance, PAN cards and things like that. We can't say how much of it was due to which reason. But we know that overall, post demonetization, it really dropped. We might see this going back in the new environment of mandatory hallmarking, better compliance. With all that, we might see it going back to the pre-pandemic, pre-demonetization levels.
How do you see the global central banks respond to all these developments going ahead? What does it do to the gold ETF demand in India as well as globally?
Well, as you know, the globe, first thing, let me deal with the ETF part. There was an inflow of 9 tons in India. It was, again, a good year. But in the overall scheme of things, a 38-ton AUM is good, but it is compared with the jewelry or a bars and points demand, it is still a very small fraction. Coming back to central bank, I think it was one of the best years again. It was much, much better than what we saw in 2020. They bought nearly about 480 tons of gold. We think they will continue to buy. We did a recent survey. Our central bank team did a recent survey of central banks, and they are very positively inclined towards gold. Now, central bank, forecasting the quantum is always a difficult thing because it is more a question of policy than pure price play. So looking at the actions, we believe that they are positively inclined towards gold, and therefore the buying will continue.
Thank you, Som. Thank you so much for sparing the time today.
Several leading jewelers have meanwhile appealed to the government to reduce the import duty on gold in the upcoming budget. The union government is now busy giving final touches to the contours of the budget, which will be presented on February 1st. India's budget can be classified into two parts, the capital budget and the revenue budget. Let us dive into the details of the latter today.
The revenue budget consists of the Government of India's revenue receipts and the expenditure that is met using said revenue. It gives the details of the sources from where the government's revenue is coming. Revenue receipts can be further classified into tax revenue and non-tax revenue. Income tax, corporate tax, excise, customs and other duties make up the tax revenues. Corporation tax is the biggest source of revenue for the government. Public and private companies registered under the Companies Act 1956 are liable to pay corporation tax. It is levied on the net income of the company. The collection, surcharge, cess and other receipts make up a huge chunk of the revenue. While non-tax revenue is the recurring income earned from sources other than taxes. They include interest receipts, received on loans given by the government to states, railways and others, and dividends and profits received from public sector companies. Non-tax revenue also includes disinvestments that the government undertakes in companies where it holds a stake. The payments that go towards the normal day-to-day running of the government's departments and the various services that it offers make up the revenue expenditure. Servicing interest on its borrowings, along with subsidies, among other things, are the other expenditures that the government has. Any expenditure that does not go towards the creation of assets, along with grants given to state governments and other parties, are examples of revenue expenditure. Finally, the government spends more than it earns, because of which the difference between revenue receipts and revenue expenditure is usually negative. This difference is called the revenue deficit.
Quipping about the rising fiscal deficit in his country, former US President Ronald Reagan had once said that I am not worried about the deficit. It is big enough to take care of itself. That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.